Hi, and welcome to another episode of Working Dad Trader. In this episode, I thought I would do a quick sort of talk about what's been happening on recent events. And I'm not talking about Harry and Meghan and the dramas with the royal family. I'm talking about the stock market and what's been happening there and the correction that's been going on. If you could remember to smash that like button and subscribe. And I thank all of my public subscribers for doing it, and I'm so grateful for all your support. It really, really does help my channel. So thank you very much for people that have already done that. And let's go and have a look at the video, and we will look through what's been happening. The stock market was booming. Millions of new retail investors opened accounts all over the world. There was plenty of money to be had. The times were great. We were all having a great time. Easy money. We could get on the bandwagon on any stock. We were following all sorts of rubbish companies that were being suggested on chat rooms and on social media and other sources. No one bothered doing any checks because it was great. It was all easy money. Everything was going up. We all piled in. We all thought we were the wolf on Wall Street and we were all going to be millionaires. But then, what happened? A crash. The stock market had had enough. It was doing what it always does, and as a healthy correction, it was time to throw these new retailers off the bus. These new investors were not ready. They didn't know what to do. They've never come across this before. They thought it was easy. Suddenly their accounts were losing 50, 60, 70%. Stocks plummeting everywhere. What to do? They had no idea. So they panicked. Where's my money going? There were blood on the streets everywhere. Just sell, sell, sell. Try and get anything you can. What a disaster. Okay, so enough of the dramatics. This has been coming on for a while. I've said in many of my previous videos that I'm expecting some type of healthy correction of 10%. Sure enough, it's come. The signs were all there. There was lots and lots of hyped up stocks and sectors. We were right at the very top on a lot of sectors of where the stock would go in the height of the cycle. People were being greedy, and as Warren Buffett always says, that to be fearful when this happens. We've all been preparing this for a while. This is not a time to panic. This is a time to be calm, be patient, be disciplined. We all have to take losses. That's part of stock trading. My portfolio has gone down, but it's not time to get crazy. It's a time for calm and wait for it to start correcting. If anything, I've been adding a little bit to a lot of the positions that I feel are strong companies that was going to be rebounding in the near future. And by the end of the year, all of this will be forgotten. Okay, so this is the Nasdaq 100 index. This is the index that got hit the hardest in the recent downturn. If we look at the chart, you can see that within the Bollinger Bands, which are generally, the Bollinger Bands are like elastic bands. The candlesticks generally stay between the Bollinger Bands, and when it gets, as it's before it, we had the dip, it was at the very top edge of the Bollinger Bands, and it's a bit like an elastic band. It then springs back towards the middle. That's one of the reasons, indicates why we had a downturn and why it's been oversold for a long time. As we see now in our current situation, we're at the very bottom of a Bollinger Band, and we've hit the red, gone past for a few days on the red 100 moving average. It hit that and then corrected itself, and it's now springing back up towards the middle. That's why I think maybe it's a good sign that we're back on the recovery. And one of the most publicised reasons was the raise in the 10-year Treasury Yield bond, which was around 1%, slightly just over, and it went to a high of 1.62%. This made investors really quite nervous and fearful. Obviously, when they're looking at what to invest their money in, when the yield was only 1%, and then they can get higher returns with stocks than bonds, So that's why a lot more money was in the stock market. But when it's gone up to 1.6%, then investors are looking at the 10-year Treasury Yield bond as a sort of safer bet. It's also the yardstick that other investments measure against. So with this, when they're looking at intrinsic value of a stock using their calculations to make what's a fair value of the stock, it changes the maths completely when the Treasury Yield is a lot higher, which then when they put the new figure in of 1.6 say percent, it makes stocks more expensive and not so good for investing in when they become far too expensive, and they don't think they're getting good value. So that's when then they start taking their money out of stocks because it looks more expensive than it was, and that's one of the reasons it's caused this downturn. So now is not the time to panic. Now is the time to keep calm. As long as you're invested in really, really good companies, fundamentally good companies with strong balance sheets, strong financials. What I mean by that is the basics that you need to be looking for, which is increasing sales growth over 3-4 years, increasing net sales over 3 or 4 years, increasing free cash flow is also a great indicator to see in the financials. You're looking at companies with low debt that is low and is, if better, is decreasing. You're looking at make sure they've got way more assets than they have liabilities, and they're not got lots of liabilities and debts. That need to stay away from that. As long as you're looking at those basics and you're ticking off the basics and you're in good companies, good solid companies like that, then it's just a case of sitting it out. In a couple of months' time, this will all start going back up because all good companies will go back up, and I expect us to be within 3 months back to the levels we were back in the start of February. If you've got any little bit of cash possibly available, again, do your own research, assess your own risks. I'm not advising anything, but it's a reasonably good idea to look at if you could possibly increase the position if the companies are a good company. But like I say, do your own research, do your own homework, see what's best for you. That's certainly what I will be doing. But it's definitely a time not to be crazy, not to panic, and not to sell out. Because remember, you don't lose money until you actually sell. If it's running at a loss in your portfolio, it's still in your portfolio. In another year's time, it could be profitable. So remember, it's not a loss till you sell. Okay, so thank you very much for watching. Hope you gained something of that, and remember to hit the like button and subscribe, and I shall see you soon. Okay, take care.